Inflation is a reality somebody cannot run away from. As an investor, you actually need to devise a means of mitigating inflation. No matter how we do, there's that tendency that inflation would certainly affect our investment returns one way or the other. And so, since we can't really escape this particular circumstance, what do we do about it? We need to hedge, to find a hedge, a way of hedging, against inflation. And that's why in this video we're talking about how to use Forex as well as currency ETFs to hedge against inflation. How you could use Forex or foreign currency trading, as well as currency exchange traded funds, that's currency ETFs, to hedge against inflation. So both forex trading and currency ETFs can be effective tools for hedging against inflation, especially when traditional investment like stocks and bonds may struggle during inflationary periods in the economy. So here is how these instruments can help protect your portfolio against inflation. Number one is understanding inflation and its impacts on currencies. Understanding inflation and its impact on currencies. Inflation actually, erodes the purchasing power of money, and its effect can be, it can extend to various asset classes. So, in particular, inflation can weaken a currency, as the central bank may reduce interest rates, or increase money supply to combat rising prices. And this can lead to a decline in the currency value, and not only that, it would as well affect investments in both domestic and foreign markets. So once the central bank intervenes, you discover that it will affect your investment both in your home country as well as investments outside the country. Number two is using Forex to hedge against inflation. Using Forex to hedge against inflation. So Forex, same thing as foreign exchange. Forex trading involves buying and selling of currencies. So here is how you can use it to hedge against inflation. It could be done by buying strong currencies. You buy strong currencies. So during inflation, inflationary periods, you discover that investors may flock to stronger, more stable currencies like the US dollars, like the Swiss francs, and other related currencies. And this will tend to hold value. It could hold value better than other currencies, in times of rising prices. So buying these currencies in the forex market can offer protection from inflation-driven devaluation, of weaker currencies. Whenever the government devaluates currencies as a result of in order to cope with inflation, you discover that, and the only way out is to invest in stronger currencies. You could as well, sell weak currencies. You could sell weak currencies. So on the flip side, you can sell currencies that are prone to devaluation due to higher inflation, such as those from countries, experiencing economic instability, or runaway inflation. For example, during periods of high inflation, emerging markets currencies may be weaker. It may weaken, actually, making them less attractive as a store of value. Number three is using currency ETFs to hedge against inflation, using currency exchange traded funds to hedge against inflation. And you discover that currency ETFs, provide a simpler and more accessible way, to invest in foreign currencies without the need for active forex trading. So here is how uh, they can help, hedge against inflation. If you don't want to actively, trade forex, which might result in losses if you're not really experienced or skilled in that field, so you could, partake in foreign currency returns by investing directly, in a currency exchange traded funds. So uh, you could do that by diversifying into emerging market currencies. You diversify into emerging market currencies. So in some cases, emerging market currencies may benefit from inflationary pressure, in developed economies. For example, if inflation is in developed, in developed currencies, that tends to, if it dries up or if it drives up, commodity prices, currencies or commodity exporting countries like, the Australian dollar or the Canadian dollar may strengthen, potentially benefiting currency ETFs that track these currencies. So you just simply, invest in those ETFs, and they will then handle all other matters regarding trading in foreign currencies for you. And not only that, you have commodity-based currency ETFs. We have those that specialize in emerging market currencies. This other one is kind of is commodity based actually. So they specialize in commodities. Some currency ETFs, are linked to commodities like gold, like silver or oil. So these can be particularly useful during inflationary periods when commodities, tend to rise in value. Usually during periods of inflation, you discover that commodity prices will tend to rise. So you could benefit from that particular action if you invest in currency ETFs that tend to hold commodities. So a currency ETF that tracks the value of gold or oil can help protect against inflation. As these assets usually maintain their value in times of, in an inflationary environment, they will see maintain their value. They don't really yield to inflationary pressure. Number 4 is inflation, inflation hedging strategies. We want to consider inflation hedging strategies. So one of those strategies is, currency pair hedging, a currency pair hedging. So in this regards, you use currency pairs in foreign trading, in forex trading to hedge against risk. For example, pairing a strong currency like the US dollars with a weaker currency, from an inflation affected region, allows traders to profit from inflation while protecting their portfolio. This is quite ingenious, Not only that, you can equally consider, tactical asset allocation, tactical asset allocation. So in this instance, in terms of inflation, you adjust your asset allocation, in favor of currencies that are likely to outperform in an inflationary environment. So currencies, currency ETFs offers an easy way to implement this strategy, by providing broad exposure to foreign currencies without directly getting involved, in forex markets or in forex trading. Please like this video and subscribe to this channel if you've not done that. It will then really encourage me to continue bringing contents of this nature to you. Number 5 is advantages of currency ETFs for inflation hedging. So what are the advantages of utilizing currency ETFs to hedge against inflation? Number 1 here is low correlation with other assets. They don't really correlate so much with other assets. Currency ETFs typically have a low correlation with other assets, classes like stocks or bonds. making them an effective tool for reducing risk during inflationary periods. Another, solution here is like another advantage that it provides liquidity. Is another, benefit is the provision of liquidity. So currency ETFs are highly liquid, actually, enabling investors to quickly adjust their positions in response to inflationary changes. So that liquidity is very, very important. And we followed by diversification. So currency ETFs allow investors to diversify their holdings, across many currencies, reducing the impact of inflation on a single currency or on a single region. You could buy the British pounds, you could buy the US, dollars, you could buy the Japanese yen and other currencies, you know, to be able to hedge adequately against inflation in your home country or your domestic country. So, in conclusion, forex trading and currency ETFs can be can be a valuable tool for hedging against inflation by providing exposure to currencies that maintain or increase in value during inflationary periods. And so, inflation actually, we can't run away, we can't escape inflation. So, what do? We diversify away from traditional investing like stocks and bonds, and then we can invest, in forex if we have the expertise, or we can invest in currency ETFs so that we'll be able to mitigate the impact of inflation on our overall portfolio.